Alibaba's latest quarterly results confirm that the company is firmly in a transition phase, shifting from a growth maximization model to a capital-efficient, cash-generative business. Revenue growth remains modest, but profitability, free cash flow generation, and shareholder returns continue to improve. The quarter reinforces the view that Alibaba is no longer a pure growth story, but rather a large-scale platform optimizing for margins, discipline, and long-term optionality, particularly in cloud and artificial intelligence. Revenue performance and growth dynamics. Total revenue increased at a low single-digit pace year-over-year, broadly in line with expectations. The overall growth profile reflects both macro constraints in China and Alibaba's deliberate strategic choices. China commerce revenue showed signs of stabilization after several quarters of pressure, supported by improving user engagement and more rational competitive behavior across the domestic e-commerce landscape. While pricing competition remains intense, the pace of deterioration has clearly slowed. International commerce continued to be the primary growth engine, delivering double-digit revenue growth. AliExpress, Lazada, and Trendyol benefited from cross-border demand and improved logistics efficiency. Importantly, international growth is increasingly driven by scale economics rather than purely promotional activity, which is positive for medium-term margins. From an institutional perspective, the key takeaway is that Alibaba's top-line trajectory is no longer the primary driver of the equity story. Instead, revenue stability combined with improving profitability is becoming the dominant narrative. Margins, cost discipline, and free cash flow. Profitability was the most notable aspect of the quarter. Operating margins expanded meaningfully compared to the prior year, driven by tighter cost controls, organizational streamlining, and a more selective investment framework. Management continues to deprioritize low-return initiatives and loss-making expansion, particularly in non-core or highly competitive segments. This approach is translating directly into stronger operating leverage and higher free cash flow. Free cash flow generation remains robust, reinforcing Alibaba's ability to self-fund strategic investments while returning capital to shareholders. From a hedge fund or institutional standpoint, this improves downside protection and reduces reliance on multiple expansion to generate returns. Segment-level analysis. China commerce remains the foundation of Alibaba's earnings power. Taobao and Tmall showed early indications of traffic stabilization, supported by incremental improvements in monetization efficiency. While growth is not accelerating, the segment is clearly being managed for profitability rather than market share at any cost. International commerce is emerging as a structurally important growth driver. The segment benefits from a longer runway, lower penetration rates, and improving unit economics. Over time, this business could represent a disproportionate share of Alibaba's incremental value creation. Cloud computing and AI. Cloud revenue was relatively flat year-over-year, reflecting ongoing restructuring and the exit from lower-margin contracts. However, this should not be interpreted as a deterioration in strategic relevance. Alibaba is repositioning cloud toward higher-value workloads, particularly AI-driven services. From an institutional lens, cloud remains a call option. Near-term growth is muted, but successful execution in AI infrastructure and enterprise solutions could materially change the long-term earnings profile. Capital allocation and shareholder returns. Capital allocation remains disciplined. Alibaba continued to execute share buybacks during the quarter, signaling management's confidence in intrinsic value and reinforcing its shareholder-oriented posture. At current valuation levels, buybacks are meaningfully accretive and represent one of the most efficient uses of capital available to the company. Combined with strong free cash flow, this provides a structural support to the equity, even in a low-growth environment. Management outlook and strategic positioning. Management maintained a cautious but pragmatic outlook. There was no attempt to overpromise on growth acceleration. Instead, the focus remains on operational efficiency, profitability, and selective reinvestment in areas with asymmetric upside, particularly AI and cloud infrastructure. This conservative guidance framework is consistent with a more mature, institutionally credible operating model, reducing execution risk and volatility. Long-term investor takeaway. Alibaba is increasingly resembling a large-cap, cash-generative platform rather than a high-growth internet company. The investment thesis now rests on three pillars. First, margin expansion through cost discipline. Second, sustained free cash flow and capital returns. And third, long-term optionality in cloud and artificial intelligence. For institutional investors, Alibaba offers a combination of valuation support, improving quality of earnings, and strategic optionality. While near-term catalysts are limited, the risk-reward profile appears increasingly balanced for long-term capital.